Good morning. I cannot hear from all of you. Good morning. Thank you, Team EIRC, for giving me the opportunity. I, CA Sanjay Kumar Saraugi, Chairman, Jharsuguda branch of EIRC of ICI, extend a very warm welcome to all of you to the second day of Golden Jubilee edition, the 50th Regional Conference of the Eastern India Regional Council of ICI. We now begin with our first technical session on the day on the topic Indian capital market, compounded or compounding. Today marks not just another conference, but a celebration of 5 decades of excellence, leadership, service, and professional commitment towards nation building. Over the year, our profession has played a vital role in strengthening financial governance, market trust, and corporate accountability. The topic of this session is highly relevant in the current economic environment, where the Indian capital market is evolving rapidly. Understanding where our market reflects compounded history growth or the future potential of compounding is essential for informed decision-making, strategic investment, and long-term financial planning. Now I request CA Kaushik Malik, Deputy Convener, Accountants Library, CA CP Study Circle, EIRC of ICI, on the dais, please. It is now time to invite eminent speakers on the dais. We are privileged to have among us Sri Pinak Rudra Bhattacharya, President and Head of Corporate Finance, IIFL. Please come on the dais, please. Sri Bhavesh A. Shah, Managing Director and Head, Investment Banking, Equirus Capital. CA Sandeep Jain, Director, National Council, ANMI. We requested to please come on the dais, please. Just waiting to come. May I request to please welcome eminent speaker CA Sandeep Jain, MD of Transcan, to please come and join in the dais. Please. Request esteemed speaker Sri Bhavesh Shah, MD Head Investment Banking, Equirus Capital, please come and join in the dais, please. Our one speaker Sri Pinak Rudra Bhattacharya ji just पहुंचने वाले हैं. We start our yes. Please come on the dais, please. I welcome all the esteemed speakers. A brief introduction of our guest speaker. Sri Pinak Rudra Bhattacharya served as the Senior Vice President and Head of Corporate Finance at IIFL Capital Service Limited. In this leadership position, he oversees the corporate finance corporate operations, including advisory on equity capital raises, emergers and acquisitions, and structuring of debt and hybrid investment. Welcome you, sir. Sri Bhavesh A. Shah. Is the Managing Director and Head of Investment Banking of Equirus Capital, based in Mumbai, Maharashtra. With over 3 decades of rich experience in investment banking, private equities, and corporate finance, he currently leads Equirus full-service investment banking practice, focusing on 5 key verticals: consumer and healthcares, technology, industrials, BFSI, and infrastructure. I welcome you, sir. C. Sandeep Jain ji is the MD of Transcan Securities Private Limited, a SEBI-registered intermediary with the membership of NSE, BSE, and NSDL, having a strong operational footprints across India. All our esteemed speakers are widely respected authorities in the field of capital markets, investment strategies, and financial research. With years of experience and deep insights into the market behaviors, they have been guiding investors, institutions, and professionals on the dynamics of growth, wealth creation, and emerging market opportunities. I request a big round of applause for our speakers. Now, to facilitate our speakers, I request Chairman Vishnu Kumar Tulsian and Vice Chairman Mayur Agarwal to please felicitate our speakers.
Hello, good morning to you and welcome to Kolkata. I'm very for your cooperation and support all types of Thanks.
Now, session handover to esteemed moderator CA Sandeep Jain for further proceedings.
Good morning, friends. A warm welcome to all the delegates to this day 2 of Icai Eye Regional Conference being hosted by the EIRC. Today, it's my privilege to moderate this fascinating session on a theme, on a topic which is very special to my heart, and it lies at the core of wealth creation journey of India, Indian capital markets, compounded and compounding. As we all know, Albert Einstein called compounding the 8th wonder of the world. And no wonder India has seen that transformation in the past decades. Indian markets have grown multifold. There have been increased participation, market cap has multiplied, and the number of demat accounts have exploded. This journey has been truly, truly, truly amazing for us. Today, as we see, there are a lot of opportunities in this space, and we have two fascinating and two intellectuals who are actually stalwarts from this industry, from the capital market field, who will be enlightening us and throwing light upon the topic of today, Shri Pinak A. Rudra Bhattacharya and Mr. Bhavesh A. Shah. Big round of applause for both the panelists for today's session. Today we deep dive into two aspects of compounding. One is compounded, that means how India has grown so far. And the other aspect is compounding. What is the shape that we expect and how things are going to unfold in the time to go forward in the future. So not taking too much of your time and diving straight into the topic, I would like to start this session by asking relevant questions and seeking their insights on this topic. And I hope the audience for today would take away a lot of insightful things from this session. So, Bhavesh, we start with you. Welcome to Kolkata.
Thank you so much, Sandeep. And thank you, ICAI, to have us here also.
So, Indian capital markets, we have seen exponential growth in the market cap of Indian capital markets. So, what are the primary factors or the primary drivers that you think has been for this journey?
No, it's a great question, and I think we have all observed the capital markets growth in the so many years. I think the private companies, what's actually happening over here, the growth that India is seeing is very transformational. It is also something which is very different compared to what we are seeing in the rest of the world. We are seeing a huge amount of potential. We are looking at India's growth as a multi-decadal growth. We are looking at a situation where entrepreneurship is flourishing. We are looking at a situation where capital market is enabling that entrepreneurship. And we are seeing value being created across sectors. We are not only seeing, one sector, two sector, but it's across sectors. And what is more important is, we are also seeing a lot of disruption in the way business is being done, again across sectors. We are seeing new types of businesses, new energies being coming in, and in my personal view, it is always the newness which will attract capital. It is the newness and it is the leadership position that will always attract capital. And we have also seen the amount of investments being done by not only institutions, also by individuals, that in the market has seen a creation of wealth. Wealth begets wealth, money begets beget. So I think more wealth people are creating, there's more incentive for people to invest money. I think it's a combination of all of these factors, Sandeep, which has led to this phenomenal growth in the capital markets, which frankly in my so many years, I've always seen a growth in the capital markets, but I think what we are seeing in the last 5 years has been just phenomenal.
Great to hear that. Now we move forward to Pinak, our second panelist. So Pinak, welcome to Calcutta.
Well, I'm a Calcutta boy anyway, so while I've been outside for 20 years, but family is here, so it's always a pleasure. And thank you, ICA.
We came to know that your in-laws also are based in Calcutta.
Absolutely.
So you're a Jamai of Calcutta also.
Absolutely.
So do you believe India is in the middle of a structural re-rating, since we have seen in 2014 the Indian capital market cap was around 1.2 trillion. Today our market cap is around 4.4 trillion. So has there been any re-rating in this journey?
See, it's not just 2014, right? If you go back into history, and I will go back even further, maybe as early as 1991, when actually the first round of liberalization happened, right? The Sensex in 1991 was around 1100. Today it is, let's say 85,000, depending on whichever day you look at the numbers, right? So think about that if a person had invested 1,000 rupees, you would have made an 84x on that. So the wealth creation has been phenomenal in this country, okay, over the past few years. Of course, a lot of factors have played a role. Our growth, particularly that we see at an economy level, is significantly better than most other countries. In the US, the trendline GDP rate is 3%. We aspire for 7 to 8%. We often make up, or almost always make it at 6%. And this is real GDP rate.
Conservatively.
Yes, and this is real GDP rate. And then you add inflation, assuming corporates are, let's say the inflation rate is 4% and the corporates are, let's say, a little more efficient. So even in a really bad year, unless there's a cyclical downturn, you will have 14 to 15% earnings growth. That 15% earnings growth should naturally translate to a 15% growth in your wealth, unless there is further multiple expansion. So I think that's an important factor which is played, because we fundamentally have favorable demographics, favorable growth opportunities, which has resulted in significant growth. But I still think, there's a long way to go. I know you spoke about this 4x growth in market cap, right? 5 years back, the market cap to GDP ratio in India was around 80%. In the US, it is 160%. Today, we are close to 125%. So there is a significant run rate to improve. Obviously, it will come through new ideas. It will also come through existing businesses doing even better. So I think we are in a sweet spot, touch wood, and I hope it continues for a while.
Point well taken, and really appreciate your views. Now, as we are gung-ho about Indian capital markets, I would like to seek the views from both of you. This multifold expansion in the market capitalization of India or the growth that we have seen in the previous decades, do you think this is more of a demand-driven growth, or is it more of a reforms-driven growth, or is it more of liquidity-driven growth, or is it more of an entrepreneurship-driven growth? Bhavesh, first for you.
So if you really step back and you look at what the century has been for us, starting from 2000, we are now in 2025. We're talking about 25 years so far. Indian capital markets raised 2.3 lakh crores in the first decade. So 2001 to 2010, the amount of money raised was 2.3 lakh crores. 2011 to 2020, the second decade of this century, the amount of money raised was 2.2 lakh crores. So put together decade 1, decade 2, the amount of money being raised in the capital market has been 4.5 lakh crores in 20 years. This decade, which is the first 5 years, 2021 to 2025 till now, we are not yet finished the year, we've already raised 5.4 lakh crores.
That's a whooping sum.
It's like, in 5 years, we have done more than what we have done in the last 20 years. Now that I think is a combination of 2-3 factors. There used to be a time where we were heavily dependent upon foreign institutional investors to kind of, do our IPOs. I remember in our, when I was an analyst and when I was an associate, we used to have slides that which will say there's a window of opportunity for doing an IPO, and which will showcase this to our clients. And that window of opportunity will be something like in a 3-year time frame, it would be just 1 year where you can do an IPO. And the reason for that is very simple. The FII money is a very moody capital. When I say moody means obviously they will go where the returns are, effectively. So whenever the returns are being made good in India, they will be investing, but when they see returns being made outside of India, capital will go away and go to other countries. So we used to see a cyclical activity in capital markets. Markets are going up, FIs are investing, companies will think this is a good time to kind of maybe do an IPO, we will get our IPO subscribed. But doing an IPO is something like a 6 months, 9 to 12 month process. By the time you're ready to do an IPO, the FIs are gone. So there was never a certainty that you could actually do an IPO. And as a result, a lot of private equity investors mushroomed significantly. Because private equity capital was available always, but at their own terms. They always wanted higher returns. They want 3x in 5 years. They will have all the terms and all that. But companies who really wanted capital would have taken the monies from the private equity. But capital market was always cyclical. Now what is happening is the onset of domestic inflows which is there in the market. Every month we are seeing 30,000 crores coming into mutual funds by way of systematic investment plan. 30,000 crores is a huge amount of money. Today the overall mutual fund industry is about 80 lakh crores, out of which the equity funds are something like in the vicinity of 35 lakh crores. We are talking massive amount of money coming every month into the system, which means we are no longer dependent upon foreign institutional investors. And what that means is the consistency of getting an IPO done. We are no longer dependent on FIIs. We have domestic investors who can get an IPO done. And today we are seeing the effect of that. So today, the cycle from a 3-year window where you could do 1 year in a 3-year cycle, cycles will always be there in markets, but I think that cycles have crunched significantly. In this year, the first quarter was very, I would say, sober because of various factors, geopolitical factors, and then various other factors. We saw the activity in capital markets was less. But now in the same year, in this last quarter, we are seeing a massive amount of activity happening. So the cycles have truncated significantly, and we are looking at capital markets being much more consistent going forward. And you know, this has got a wide range of repercussions, which I'll cover maybe later, but I'll let Pinnacle answer.
I would request Punak to add on this.
No, see, I completely concur with what Bhavesh just said, okay. And specifically, Sandeep, to answer your question, is this demand-led, entrepreneurial-led, liquidity-led? I think it's a combination of everything. The fundamental reason is demand-led, I think, because you are finding newer sectors, you are finding a lot of growth opportunities, capital is also getting attracted because of that. You know, 10 years back or 12 years back, we could not think about an IPO or a set of companies which are doing exclusively manufacturing businesses. Last 5-7 years, so many EMS companies have come up which are doing really well. Obviously, manufacturing has been the mainstay now, last 4-5 years compared to what it was there earlier. Defense companies have come up. So we are seeing newer sectors coming up. We are also seeing new age businesses coming up a lot, which were never there. Of course, I think the other thing that has happened is, I think, overall understanding of equities, while we're still equity underpenetrated, overall understanding of equities has become much better than what it was, let's say, 15-20 years back, and people are more equitized. Is liquidity driving a flow? Yes, liquidity is also driving a flow. Certain other factors have had amplifying impact. For example, how many of us in this room have lately been investing in a debt mutual fund? We don't do that because the taxation makes it a little difficult. But we're still earning our own business profits, salaries, or whatever is our source of regular income. It has to go somewhere, right? A part of it is going in equities, and as rightly pointed out by Bhavesh, SIPs are the most effective way of playing the markets, because you are trying to balance yourself against the vagaries of any cyclical movement in the market while inculcating, I guess, a saving habit.
Great, your point well taken. In the last 2 decades, we have seen a lot of disruptive events, like we have seen 2008 financial crash, we have seen natural calamities like COVID, which was one of the deadliest of the sufferings that we had. We have seen a lot of wars, we have seen a lot of geopolitical events that affected our capital markets. But still, we were fortunate enough to grow at a CAGR of 14.2% in the last 2-3 decades. So, what do you think going ahead, Pinak? Would it be easier for us, the journey in the next 1 or 2 decades, to grow faster, or will it be the same, or will it be a bit slower than that?
See, who creates demand, at least from a domestic standpoint? It is the people who actually live, who create demand. So the underlying demographics that we have today and the kind of population, the people who are below 25 years, 30 years, substantial portion of our population, that story is going to play out over the next 2-3 decades, sorry. We are a young population, we're not an aging population like Japan or Russia or something like that, right? So we believe that, we'll find, economy will have its own cycles. There is no way we can escape that, right? But the trend for continuation of the growth will continue to happen on the domestic side. On the foreign side, of course, we are becoming far more focused on even expanding presence. Many of the IT companies have done a phenomenal job over the last 30 years. We see new sectors also trying to do the same, right? So from an overall standpoint, I am extremely bullish that the next 2 to 3 decades will be that of India. Consumer sectors will do well, export sectors will do well. I don't see any, of course, cyclical sectors, there will be some sectors which will die out into the sunset. I mean, those things will happen, times will change. But fundamentally, is the economy going to do really well? The answer is yes. Are the markets going to be doing really well? The answer is yes. And specifically to answer your question, see, markets are forward-looking. If you even look at the COVID time frame, right? Markets initially had their own set of hiccups over the first 3 months, but they quickly priced in that the growth will rebound very quickly. We did so many secondary market transactions, which is called blocks, as well as primary market IPOs, where the concept of valuing it on a price to earnings was not possible, because all of these companies historically were not in profit, and we did not have visibility of profit. We saw markets taking a more mature call that pricing should be on pre-COVID profits, because that's the baseline profit which you will anyway return to in 2 years' time, stuff like that.
Can you elaborate on this point?
So let me take an example. We did a couple of restaurant IPOs, okay? And I still remember one of the restaurant IPO documents was filed on February 20th, 2020. And normally marketing for IPOs happens 50 days, 60 days after an IPO happens, right? So obviously restaurants were shut. These were all in-line restaurants, so delivery really cannot make up much. And that IPO obviously, it took 6 months to do, because if the restaurants are shut, it cannot be, you really don't know when you open and when you make money, right? So it was a tough period. But when the restaurants reopened, their earnings was never at their peak, or never back to pre-COVID levels. But people were willing to price them on pre-COVID numbers till the time the market recovered, because what markets understood was that this is a story where people are still going to go out and have food in restaurants. You still are going to have your underlying demand there. It's just a timing. But if you do not support those companies now, they could cease to exist. Maybe valuation is something, an adjustment which they will do, but yeah.
Very well said, and I truly appreciate that. Bhavesh and Pinak, both of you are avid deal makers. You have been interacting with a lot of promoters, a lot of founders to help them raise capital, to help them raise money for the expansion, for their businesses, for everything. So, what change have you seen in the past few years? Have they become more receptive towards capital market, or they are still ready to leverage on their books?
I think this is a very big transformation that we have seen again in the last so many years. There was always a general tendency when we were talking to promoters as to why should I dilute? You know, and I think the dilution was always a big concern for promoters. I remember one very funny conversation I had with one of the promoters. Actually,
You would love to hear that.
yeah, he's actually he's a Kolkata-based entrepreneur, and he asked us, "Can I raise equity without dilution?" No, so that was the question that he was posing. So I don't know whether he was asking jokingly or really seriously, or maybe he was really serious about it. But I think the dilution has been a very sensitive topic for a lot of promoters. But I think one of the biggest realization that has happened in the last so many years is that once you equitize the balance sheet, and once you kind of, I think there are two things which have happened. One is, of course, the debt. Debt has always been a one-sided capital. The banks always want, if you win, I win. If you lose, I still win. Which means the interest payments to me should always be on, irrespective of what is happening to your business.
That's quite a contrast.
Exactly. So the business has cycles, but the capital alignment is zero as far as debt is concerned. Even the government, for that matter, is very aligned. Government says, whether if you make profit, you give me tax. If you make losses, okay, don't give me tax. But the debt guys always want the interest, irrespective of where the cycles are. So this, I think, is a complete non-alignment of capital provider and the promoter. Equity capital gives that significant amount of alignment to the business. And that, I think, is where the promoter is then able to focus more on the business rather than focus on the vagaries of the business and then how it will impact his capital, how the capital structure is going to impact his profitability, etc. I think that has been very important trend, number one. Number two, there was always a situation where because of tax savings or because of whatever, I think there was always an inclination to not reflect the true picture of the business in general. I think that was always the mindset, and which always created that the company is not performing. The company seems to be very big, but when you look at the profit after tax, the numbers are not showing up, for whatever reason it may be. And that never kind of really helped take the equity capital market or of that stock or the market capitalization of the stock to kind of really grow. I think once the realization started coming into the minds of companies that equity is little more aligned to the capital structure, to my business, and your reliance on the debt has come down, the propensity to show the truer picture of the business has gone up significantly. And that has resulted in the stocks doing well, and that has resulted in more capital coming in. I think that is a transformation which has happened in the recent times. And one very big change that we are seeing right now is also the democratization of the capital markets. You know, we as investment bankers would make a lot of trips to Delhi, even Calcutta, Ahmedabad, or some of these, you know, few cities from Bombay will go and kind of help them raise money. Today we are going to cities where we have never been before. We are in fact checking flights if there's a flight going to such places. And it is amazing to see the kind of beautiful businesses some of these cities have. They've grown to a big scale all these years. They have like fantastic corporate governance. They are very differentiated business models. And you know, they are now looking to see how they can kind of tap into capital markets. So it is an all-round democratization of the Indian capital markets which is happening. So to answer your question, Sandeep, I think we are seeing more and more activity which is happening towards equity. And I think you all are CAs, and I'm sure you are either the auditors or advisors to many of your companies. And you know, one very big advice probably you can give to your companies is take your company public, because the amount of value creation we have seen.
Yeah, we are also having that SME IPOs, a plethora of IPOs coming in SME sector too.
I will not comment on the SME IPOs because we work more on the main board IPOs. But what is happening is the value creation journey has been phenomenal. And the benefits of listing, I don't need to tell you all, but I think it's amazing amount of visibility that the company gets, number one. Number two, your ability to attract employees because of ESOPs and the wealth creation opportunity you're giving to the overall ecosystem is phenomenal. And you can use equity as a currency for acquisition. So the benefits of listing are immense. And there's always this thought process about, you know, compliance is heavy, disclosure heavy. Of course, you know, so I think the company has to perform on a quarter-on-quarter basis. But as long as the business is sound, as long as you're guiding to investors what your business is, if you're setting wrong expectations, it's a challenge. But if you're setting the right expectations with your investors and you're delivering up to that, we are seeing a huge amount of value creation journey that is there. And you know, one of the companies, if I may share an example, where IIFL and Equitas both, we were one of the two lead managers, we were there in the IPO. We were the left lead and IIFL was also there. It's a company called NetWeb Solutions. And it's a Delhi-based company. So I'll tell you about the story over here. So we had approached them, and they are like a 20-year-old company. 40 crores of profit after tax. And we kind of went to the company and said, we can do an IPO for you. And they said, IPO for us? He said, yeah, of course we can. So then, you know, what do you think, what value we should get for IPO? So we said, you should, you know, you tell us what value you want. So they were thinking about something like 1,600, 1,700 crores valuation. If we get, we'll do an IPO. So I think as a team, we got together. And I think we developed, you know, what does the company do? They are into supercomputers. One of the very few companies in India who are into supercomputers. But, you know, we kind of, you know, devised a story around India. Frankly, supercomputers, nothing but dabbas, you know. At the end of the day, computers are dabbas. But they are into supercomputing. So we devised a story that AI is in. We don't want to be kind of, you know, to develop AI, you need more supercomputing. We don't want to be dependent upon China. Here is a homegrown company which has been nicely growing over the last 20 years. Good quality promoters, good business, good set of clients. And I think we got something like a 220 times subscription on the QIB front.
That's phenomenal.
And we did not do the IPO at 16, 1700, nor at 2000, nor at 20. We did the IPO at 2700 crores. It got listed at 4,000 crores.
And it has also created a lot of wealth for the investors.
And today it is at, I think if I'm not mistaken, it is at 16,000 crores valuation.
4x.
So they actually delivered whatever expectations was there in terms of profits, they delivered on the profits. In fact, they delivered better. And that is what investors from the capital markets like. That if you're setting an expectation, if you kind of meet that expectation, is fine. But if you underperform, it's bad. But if you meet that expectation or maybe overperform, they want to put more and more money into the same company. They want to buy more and more of the same stock. And that is the journey which we have seen for NetWeb from what we were earlier discussing about just 2.5 years back. 1,600 crore valuation today, it is at 16,000 crore valuation. This is an unbelievable journey. No amount of debt capital, no amount of private equity capital, nothing can give this kind of valuation which capital markets are giving. So, that's what I was suggesting, that this is the value creation journey, and as you are all advising and companies are dependent upon your advice, this is a great advice you may want to kind of consider to give your clients, your companies, that how value can be created in the capital markets.
That's great. Love to hear that. Pinaka, I would like to request you to please add on to this your personal perspective on deal-making scenario.
No, see, fundamentally, what we have noticed over the last 10, 15 years is that corporate balance sheets today are much better than what they were in earlier on. Okay.
Truly agree to that.
And promoters are also very conscious of how their balance sheet should look like. That is one point. The other thing that we have noticed is that promoters, okay, the question is, there was a time when I wanted to be the owner of a small house, okay? I have seen a mindset change over the last 10, 15, 20 years where we are seeing entrepreneurs tell us we want to be a large owner, not a 100% owner, but a large owner of a very, very big tower, for want of a better word, or twin sets of towers. I'm happy to share that wealth, but if I get capital, I have the capability of building those 2 towers. If I don't have the capital, I will be a full owner of a very small home. I think that's one change that has happened. The other change, and certainly Bhavesh had briefly alluded to that, promoters themselves want more professional management in, because they believe that they need that external help also, which will help them build those towers. So that's the second point which we're seeing. And we've also seen, we've seen many companies where 100% owned by promoters, but increasingly we are seeing promoters even call us before they start our listing event, introduce us to some ESOP consultants. We want help, we want to structure a scheme for our employees, we want them to partake in our wealth, and we want that team to continue for the long time. So that's also a structural change that I am noticing over the past, I guess, few years and so on and so forth. But I think it's important that whenever you do it, first of all, it's much more easier to raise capital and grow in a listed company compared to an unlisted company. An unlisted company, if you want to, obviously if you're not of the right scale, then possibly personal wealth, friends and families are the first source, port of call. If you're of a reasonable scale, not of an IPOable scale, you will look for private equity investors. The day you take private equity money, I can tell you, that day you've already decided that you have to list, because those are finite pools of capital, right? 3 years, 4 years, 7-year pools. They have to return their own money to their own investors, right? If you want to do acquisitions, you need a listed vehicle and stuff like that. So we are migrating to a situation where everybody is comfortable towards listing, particularly the larger entrepreneurs. We are also seeing a lot of first generation founders coming up, particularly in some of these new age companies, right? They don't have the external capital, so they know that listing is the right event at the right stage. Of course, not every company can list itself. So those are some themes we see playing out very effectively in the markets. But it's critical that in a liquidity event, you under-promise and over-deliver. Give the bad news first. Don't hold on to that news. See, there is no science as to why a stock should trade at a price to earnings of 10 times or 35 times. Of course, growth is at play, but hygiene factors are also more at play. Investors want more predictability. They understand cycles. So those are some of the things that I guess are fundamental shifts that are important. Why does Infosys trade at that multiple? They always under-promise and over-deliver. If you promise 97 and deliver 100, people will give you 3 turns extra multiple. You promise 105 and deliver 100, people won't be so happy.
Absolutely, absolutely. Yeah, after one. So before we open the floor to the audience for questions, just one or two questions from our side. So Bhavesh, one thing most of us sitting here would like to hear from you as well as Pinak. What do you foresee as a mega trend in 2030 which will surely help us see compounding, or any sector that you want to speak about?
So as I said earlier, I think we are in a multi-decadal growth. So 2030 will just be a milestone in that journey. I personally feel 2026. Let's first begin with that, because we are in 2025 and 2026. 2026 we are expecting something like $20 billion worth of capital being raised from the IPOs. In terms of sectors, again, I think it's going to be broad based. If you look at India for the last 20-25 years, it has been a service dominated economy, more software, more financial, so all of that put together, very services dominated economy. The next 20-30 years are going to be manufacturing led economy, and frankly I saw quite a few activities that we are having. One is the infrastructure investment that is happening in the country. The supply chain, we all talked about China plus one, India manufacturing, all of that. Yesterday I read an article by one of the very prominent persons that India was always considered to be very high in terms of logistics cost. Something like 12-15% of the overall cost is logistics cost. And he had done a lot of analysis around that, and frankly he came back to the number which is only 9%, which is comparable to a lot of developed economies in terms of logistics cost. So there is always this excuse that logistics cost in India is high, how can we grow manufacturing, which is not the case. So I think a combination of all of that is driving the impetus towards more manufacturing. So from a shift perspective, we'll see more manufacturing. We will continue to see domestic investors being very active in the capital markets. This year has been a trend where FIIs have been selling a lot out of India. They've been investing in markets like Taiwan, South Korea. South Korean market this year was, India was only up 8 or 9% this year, 6-7% this year. Taiwan and Korean market has gone up 66% this year. And largely it was basis the AI driven stories. So FII money was going towards AI, and these countries have semiconductor companies and which a play on AI. So I think the money was going there. But now I think there's also a kind of a realization happening that the valuations have gone up too much for AI, and valuations in India have been they were high, but they've been around that same level. So we are expecting FIIs to start coming back into India. So I think domestic capital will be there. We are seeing FII money to be coming in. We are seeing very good quality IPOs to come into market. We might see NSE coming into IPO. We might see Reliance coming into IPO. We might see even more digital companies going into IPOs. We are seeing a lot more democratization of the Indian capital market, tier 2, tier 3 cities, beautiful businesses coming into the markets. We are seeing the trend where individuals will start putting more money into equities. That's the trend. I think these are broader macro trends. Very difficult to pinpoint what will exactly happen in 2030, but I think we are expecting, unless some very big black swan event happens. Now again, you mentioned about various wars that have been happening. One of the biggest things about our market, or all of us put together, is the adaptability that we all have. See, we get used to adversities and we take them in our stride. For us to shake up, we just need a very big adversity again. So I think the small wars, small COVIDs here and there is not, we've just been all through that. Now something really big has to happen for the market to really shake. But again, we have seen from COVID how we have come back resilient after that. So even if something like that happens, it'll be just a blip and then we'll be back on track.
Pinak, yours?
No, I think the sectors are right. Manufacturing, defense, these are some of the new sectors which will certainly do well. Some of the new age companies, of course, particularly some of them have become really, really large. I mean, just saw the Denscard IPO happening, right? So I think those are some themes that will play out. I think also increasingly, we might find some of the MNCs listing in India. That's a theme we have seen play out last 12 to 18 months.
Yes. LG
Because no amount of paid publicity can supplement or supplant a listed company in India. There is a Nestle, LG, they don't need to really list in India because they need the money, right? They are listing for have underlying connect to the people. So that's another theme I think we expect to play out. I think the other theme which will play out, although that sector has lots of companies already, and I don't know whether IPOs will be the way out, but certainly earnings growth will be there, will be financial services. Because let's not underestimate, while people are looking more into equity, there is a market for debt. While corporates are looking to have better balance sheets, there is a fundamental SME sector which requires debt which is not otherwise available easily through equity, because those companies, entrepreneurs, sole proprietors do not really have that access to equity, right? So the underlying driver of financial services sector towards the overall economy to be able to achieve some of the numbers that we think we can achieve will be also important. I think that's the two bits that I want to add on top of that.
We'll be looking forward to all these things that you said. Now we open the floor for public questions, audience questions. Definitely would love to hear a question from you.
NetWeb solutions, yeah.
Please raise your hand if you want to ask. Yeah, we have one.
Please come here. Come forward.
One there. Please say your name and to which panelist you want to ask.
I'm Sanjay Maheshwari, a small investor. What is the remedies left to an investor in case of misstatement or false statement in IPO documents?
You want to answer? Or you want to answer?
Okay, the first see, our regulator is highly vigilant. At least I can tell you, the main board IPOs are subject to rigorous review by SEBI. That is point number one. So you cannot do a main board IPO today unless SEBI has reviewed it, obviously in terms of adequacy of disclosures. Misstatements are technically, if there is a material misstatement, somebody has misprinted a spelling is something different, but I think your question, sir, is material misstatements, right, in the prospectus. Material misstatements in a prospectus, the forum at SEBI is there for people to say. Technically, as a shareholder, there could be a violation of the Companies Act for which you have the legal recourse in a court of law. Any money that the company today raises as primary capital for an IPO greater than 100 crores, there is a monitoring agency who is separately appointed who actually monitors the use of proceeds of that IPO. So there are lots of checks and balances, sir. I can't tell you that the system is foolproof, but our regulators are highly vigilant today. And if you go to the regulator's website and you see some of the regulatory action that they take against companies, they are fairly detailed, and the number of examples are numerous. So we have very vigilant regulators also. Obviously, we are all human beings at the end of the day.
I think one lady was there who wanted to ask a question.
Due to time scarce, we only take last questions, please.
Good morning, all the panelists. My question is not to any specific panelist, but I think you touched upon the AI point. So AI is going to be a buzzword in the capital markets in the next 5 years. So is AI a bubble, and what are the algorithmic requirements, how companies are going to monitor this in terms of IPO readiness?
So it's a very big phenomenon we are all witnessing as as a transformation that we are seeing. We are looking at how do we use. I mean, I think really if we were to step back into the history of mankind, there have always been revolutions which have been very disruptive and very user-friendly. So we got used to railways to begin with, you know, the locomotives and the transport to begin with, airlines to begin with, computers came, you know, the printers came and the Xerox came and all of that. So I think this is one of the big revolutions that we are seeing as a mankind. Bubble is from a point of, is it from a valuation perspective you're asking, or is it from a...
In terms of algorithmic trends and obviously the PE investments and all this, I don't know what the regulatory framework as of is not so much defined in India. So like how our investors should look about it.
I think the AI landscape is, we are very new to the AI landscape as a whole world. It is still very, very evolving. I think the way to think about it is how do we kind of use the best of AI in our everyday lives, and frankly, in investment banking and in a lot of areas, I'm sure all of us put together. ChatGPT is just one angle of it, but there are so many tools available which really help and kind of help your processes. We are, I was talking to some consultant, who was a business consultant. So they would deploy something like 20 people into a company for a particular project. Today they are saying, I don't need to deploy 20 people, I will deploy 15 people and I'll put 5 AI agents. So that's how the productivity is being improved. And they're charging for the AI agent instead of, having the people. So this is very transformative. I think we all have to be adaptive to it and yet be careful in terms of how that goes about. And I think...
And to add upon this, you asked specifically about algorithmic trading.
Yeah.
So SEBI has come out with a lot of consultation papers earlier. They've also framed a lot of rules, a lot of circulars have been issued recently since I have been in this field of intermediaries. So we keep on receiving a lot of updates on a day-to-day basis regarding how we can offer algorithmic trading or automated trading to investors, along with protection and along with the safety that needs to be taken care of. So I think it's a phase which is in evolution phase, basically. And it is definitely going to grow manifold from here. We are just at the tip of the iceberg now.
I think, thank you so much for addressing my point.
Thank you.
Thank you very much.
I think we can conclude since we are having a positive time. So thanks a lot to both our panelists, Bhavesh Shah and Pinak Rudra Bhattacharya, for giving us a lot of insightful learnings on the topic. And I definitely am very sure about that. A lot of takeaways have been there for all of us, all the audience, and they have gained a lot of learnings from all this session. So thanks a lot and gratitude on behalf of ICAI. Thanks for devoting your time and coming to Calcutta.
Thank you, Sandeep, for a lovely moderated session. Thank you so much.
Thank you.
Now I request Sri Kaushik Malik to present a formal vote of thanks.
I must thank Sandeep for thanking everybody, giving the thank you note ending this session. But formal vote of thanks needs to be given. On behalf of ICI EIRC, I thank Pinak Rudra Bhattacharya and Bhavesh Shah for giving us this wonderful deliberation on Indian capital markets, compounded and compounding, and also CS Sandeep Jain for being a wonderful moderator for this first session. Thank you, everybody.